Welcome to ETF Edge, your go-to place for everything exchange-traded funds. I'm Leslie Picker in for Bob Pisani today. Stocks may have snapped a 5-quarter winning streak, but that wasn't enough to stop the red-hot run ETFs have had in 2021. Even despite the dreaded September swoon, ETFs still managed to rake in $46 billion in inflows. Now the 10th straight month of inflows north of $40 billion. Still on pace to break records by year-end. Meantime, investors clearly trimmed their exposure to longer-term bond ETFs in favor of short-term government bond ETFs as rates started creeping steadily higher. So let's dig into these September flows a bit more, key sector trends, and what that all spells ahead for October, typically the most volatile month of the year. Joining us now is Dave Noddig, Director of Research at ETF Trends, Will Rind, founder and CEO of Granite Shares, and Matt Bartolini, head of Spider America's research at State Street Global Advisors. Gentlemen, thank you very much for joining us. Dave, markets go up, markets go down. Just in this recent market, though, it feels like flows just keep coming into ETFs. Is it such that this is still kind of a bull market phenomenon, or do you think that even in the case of a significant downturn that we will see these types of flows into ETFs?
Actually, history would suggest that the more volatility we have, the more people are going to look to ETFs. Remember, every time we have one of these big drawdowns, and we really haven't had a big one here, it's hardly been a crash, but every time there's a drawdown, there's an opportunity for people to sell an underperforming active manager that maybe isn't a mutual fund, or to take a hit on a tax position that maybe they've been hanging out to wait on. So these are really great opportunities for people to reassess their portfolios. And when they do that, they often end up back in the ETF market, often looking at fairly low cost, fairly, plain vanilla type equity exposures. So what we've seen in the very recent history in September was still about a 2-to-1 equity to fixed income ratio in those flows. That's a little bit less than it has been. We've been running about 3-to-1 equity to fixed income. But more importantly, when you get under the hood, it does look like people are starting to play a little more defense with some inflation plays. We've seen things like a lot of flows into real estate. That was a bit of a surprise to me. People are really looking for opportunities to profit from some of this maybe embedded structural inflation.
Yeah, it does certainly seem like an inflection point. And of course, fixed income in terms of ETFs has just boomed over the last year or so in a way that it's not too surprising to see people taking advantage of in this new regime, or looking ahead to a potential new regime in terms of monetary policy. Matt, on that front, what sort of sectoral shifts, what types of product shifts have we witnessed in recent weeks, recent months with regard to ETFs?
Yeah, I mean, from a sector perspective, one of the shifts we've seen is that there hasn't been some. So sector ETFs have had inflows in 12 consecutive months. That's the longest streak they've ever had. And over that time frame, they've taken in $92 billion. And I think that speaks to some of this disparity or dispersion within the markets right now, where investors are trying to utilize beta instruments in an active manner to tactically adjust portfolios based on prevailing macroeconomic data. For instance, in the past month, energy ETFs had over $2 billion of inflows as the spot price of oil continued to creep higher. And we also saw the inflows into energy ETFs coincided with an uptick in call volumes. So we saw, again, like a multitude of investor types expressing viewpoints within ETFs. Now, there was a bit of a shift when you look at it from a cyclical versus defensive perspective. And it's really sort of reflective of some of the lack of leadership in the marketplace. In the last 3 months, you had defensive sectors taking in more, and then it was cyclicals, then it was defensive, now it's cyclicals again. And even within that sort of cyclical camp, energy and real estate led the way, but a lot of people sold out of financials, which I think is interesting given the relationship to interest rates. But all told, we're still seeing a lot of investors utilize the construct of sector ETFs to play specific tactical asset allocations, particularly when return dispersion is so high. And I'd expect that to continue because we are heading into the fourth quarter, typically is the more volatile quarter historically, with also some pretty decent outliers. But also that macro risk calendar is pretty full when you think about what's going on down in Washington.
Yeah, that's absolutely true. And especially as you mentioned, as we are now officially in the fourth quarter of the year, it's expected, at least from a calendar standpoint, that we could see some more volatility.